To my opinion, the biggest hurdle for ESG integration is the fact that a lot of people view it, and the industry still views it, as a separate issue. They look on one hand to financial factors and then think that ESG factors something different, whereas it is actually complementary to each other, because the value of a company is derived by looking at their financial figures, but also at their at the moment non-financial issues, which at a later stage can transform into a financial issue. So I think the biggest hurdle right now is the fact that it's viewed as separate issues, and therefore I think the fact that you call it ESG is probably one of the biggest hurdles of ESG. We should just call it additional non-financial factors with which we value companies. So I think that's the biggest hurdle.
Okay. Does integration also mean an urge to keep asset management more nearby or even in-house?
Not necessarily. It does create the urge to monitor external managers much closer than probably we did until now. It means that we also have to have active dialogue and engagement with asset managers on how they integrate and how they engage with companies. But I don't think that doing everything in-house is the perfect solution. I think actually you can't do everything in-house. But it also depends on size. Larger investors and asset managers can do more in-house than smaller ones. But for smaller asset owners, definitely you can do it very well by outsourcing it at 100%. It just means you have to integrate it in your monitoring process and also be accountable for it. So report to your stakeholders, be transparent about it. So you don't have to keep it close by, but you have to keep a close watch.
How do you define sustainability?
From an investor's point of view, I would define sustainability as getting good returns for today's generation without jeopardizing a future generation's right to do the same. So that basically it's a pretty simple definition.
But that's from an investor's point of view?
Yes. If you would do, I think everybody has a slight nuance. From an investor, I have to keep into account all the generations which I represent. We are as a pension fund, we are long-term investors. So we have to make sure that we get good return for the people that are retired now, but also good return for the future generations. And it shouldn't be a trade-off. It should be both have to be able to get a good return. So whereas in the past it has been a good return for today's generation, and we'll see whatever return we'll get for tomorrow's generation, other a bit more socially driven investors, today's generation has enough, so let's focus on the future generation. I think as an institutional investor you should balance both and say we need a good return now, but we have the same obligation for tomorrow's pensioners, so therefore we need a good return for tomorrow's generation as well. And one shouldn't go at the expense of the other.